Welcome to Behind the Advice, the podcast for Australians living abroad who want to maximise their financial situation. I'm your host, Mitchell Kelsey, a financial advisor at Runway Wealth Management, and in each episode, I'll be sitting down with other experts and professionals to get their insights, stories, and expertise on key concepts for Australian expats, as well as providing my own perspective. With this being a financial podcast, there is a disclaimer, so any information that you hear in today's episode is general information only. It is not personal advice, so it does not take into account your personal situation, goals, or objectives. If you do need personal advice, feel free to reach out to us at Runway Wealth Management for personal financial advice. Welcome to the first audio recording of the Runway Report Newsletter, our monthly newsletter that's issued to our subscribers. You can subscribe to the newsletter through our website. And if you'd like to hear an audio version of the newsletter, you can listen to it on YouTube or through our podcast channel. The Runway Report newsletter is designed specifically for Australian expats. It provides a market and economic update out of Australia, as well as providing an update on any tax or legislative changes out of Australia that might impact the finances of an Australian expat. The agenda or the structure for each newsletter, it starts with a note from me as the director. It then moves into an Expat Insight, so an update or recent change out of Australia that can impact on the finances of an Australian expat. There's then a market movement section, so looking at the performance of Australian and global shares, followed by an economic update, both in Australia and globally. So without further ado, let's get into the November edition, and starting with the note from the director. So as we continue to move towards the end of 2025, share markets have experienced a really strong run this year to date. Now, following a period of strong performance, there's often an increase in news stories commenting on recent gains and discussing potential market peaks. So while these headlines can grab attention, it's important to keep perspective. So for our clients, for our subscribers, to achieve your longer term objectives, staying invested through changing markets with a diversified strategy remains the most effective approach. So trying to time short-term market movements is extremely challenging, and history shows that a steady long-term plan is the most reliable path to achieving those long-term financial objectives. For our clients, your portfolio is designed specifically to suit your personal circumstances. So for those, for example, nearing retirement or planning to use funds in the short term, your investments are positioned with these objectives in mind. So helping to protect your financial goals from any short-term market swings. Now, interestingly, markets often perform well through November and December. This is supported by factors such as seasonal consumer spending, corporate year-end adjustments, and institutional portfolio rebalancing. So while these seasonal trends don't guarantee results, they are one of the many patterns that can influence market behavior through this time of year. The focus should be on remaining focused on your long-term goals and ensuring your portfolio is aligned with your circumstances. So if you have any queries or concerns about your investments or objectives, we're here to guide and support you. So please don't hesitate to reach out if you'd like to discuss your circumstances. Moving into the Expat Insight. So the insight in this month's edition is the Australian government's recent announcement to change the superannuation or the tax rate on superannuation in Australia. So just for some context, there is a piece of tax legislation that came out back in 2023 known as the Better Targeted Superannuation Concessions Measure. So this framework was originally designed to limit the tax concessions available within the superannuation system for those individuals who had a total super balance exceeding $3 million. Now, there was a lot of consultation with stakeholders, and essentially on the 13th of October, the government watered down the initial proposals, and we now have a new set of proposals that are set to come into effect from 1 July 2026. So I'll get into the details shortly in terms of what's changed, but for Australian expats, given the significant role that superannuation still plays in wealth accumulation and retirement planning, it's really important to understand how these rules affect your superannuation savings, not just now, but into the future. So here's a breakdown of the differences between the original approach and the revised approach. So before the 13th of October, the original proposal aimed to apply a higher tax rate on superannuation earnings for those individuals who had a total super balance exceeding $3 million. So earnings on the proportion of a person's super balance above $3 million would have been taxed at 30% rather than the standard 15%. So under the original design, the $3 million super balance threshold was also fixed. It wasn't indexed, and they would also tax unrealized gains. So those would be included in the calculation of taxable super earnings. Now, those were originally proposed to come into effect from 1 July 2025. They got delayed. And then more recently, in October, we've had the revised measures come out. So the commencement date for the new measures expected to commence from 1 July 2026. So what the new legislation looks like is the original $3 million super balance threshold will remain, and they've also introduced a new $10 million threshold. So there's a bit of a stepped approach. So under the new proposal, you have earnings on a superannuation balance between 3 million and 10 million taxed at a higher tax rate of 30%, while earnings on balances above 10 million will be taxed at 40%. So it's a little bit more nuanced. It's essentially you only tax at these higher rates on the earnings on the amount that you have above these thresholds. So for example, if you had 3.1 million in super, the 3 million, the earnings on that 3 million would be taxed at 15%. But on the 100,000 that you have above 3 million, the earnings on that 100,000 would be taxed at 30%. So that's how the taxation is applied to those earnings. Really importantly, though, in the new changes, the thresholds of 3 million and 10 million will now be indexed. So meaning they'll rise over time in line with inflation or some other indexing method. So that's going to reduce bracket creep over time. Importantly as well, the new measure will no longer tax unrealized gains. So instead moving to tax only realized earnings within super. Now, the original proposal drew criticism from stakeholders, primarily due to the $3 million balance not being indexed. So that would have seen more and more individuals being subject to that higher tax of 15% over time. And the idea of taxing unrealized gains was also a sticking point in the initial proposal, as it doesn't really align with traditional tax policy here in Australia. So encouragingly, the revised measures that were released in October addressed each of these concerns. So introducing index thresholds and no longer taxing unrealized gains, the updated rules provide greater certainty and fairness to the tax rules within super and helping to protect long-term retirement savings. Now let's get into our market movement section. So in this section, we provide a bit of a market update in terms of how markets have performed through the month of October. So this is from the 1st to the 31st of October. Now, Australian shares, they hit a record high in October, but finished the month only with a 0.4% gain. Global markets rose broadly, supported by lower US interest rates, upbeat profit expectations, and easing US-China trade tensions. Japan's Nikkei 225 led the gains, jumping 16.6% after the new coalition government appointed Sanae Takashi as the country's first female prime minister. And we had Hong Kong's Hang Seng Index lagged after making some really strong gains in September. If we get into some more detail on Australian shares, so Australian shares as measured by the benchmark index here in Australia, which is the S&P ASX 200 index, it reached a new record high of 9,115 points in October. So that reflected some stronger investor sentiment earlier in the month. However, we had some higher than expected inflation data released later in the month, and that really dampened investor optimism by reducing the likelihood of an interest rate cut from the Reserve Bank of Australia in November. As a result, the market pulled back from its peak and the ASX 200 finished the month with a modest gain of 0.4%. Looking at some of the different sectors within the Australian share market, we had the resources sector led the market in October. It rose 4% thanks to stronger gold and base metal prices. The energy sector also bounced back in October, gaining 3.6% after a sharp decline in September. And we had the information technology, so the IT sector here in Australia, it fell 7% in October. predominantly weighed down by a fall in the share price for WiseTech, which is a large technology company listed on the ASX. The consumer discretionary sector also declined 6.8% in October as expectations for lower interest rates faded with that inflation data coming out. Moving to global shares, so looking at US stocks to begin with, so US share prices reached new record highs in October. The S&P 500 was up 2.3%. The NASDAQ Composite, which is essentially all stocks listed on the NASDAQ, it rose 4.7%. And that was supported by strong corporate profit growth for the September quarter. Now, among the Magnificent Seven, so these are the largest 7 stocks listed in the United States. These tech giants reported in October. They reported their quarterly earnings, and only Meta was the only company that missed earnings expectations, largely due to a one-off tax write-down in the United States. All of these US tech giants confirmed continued investment in artificial intelligence and strong demand for their services. Alphabet in particular reported that their search business remains resilient thanks to AI-enhanced search results. Now, of those Magnificent Seven companies, we've still got NVIDIA, the AI chip maker, still to report its results, and that's scheduled for November 19th. In Japan, we had equities continue to climb following the formation of a new coalition government and the appointment of Sanae Takashi as the country's first female prime minister. Investors really welcomed her just due to her focus on stimulatory fiscal and monetary policies. And then in response, we had the Nikkei 225 increasing 16% in October. So a really big increase in Japan's stock market through October. And that was aided as well by the central bank's cautious approach to raising interest rates despite some ongoing inflation pressures there. In contrast, we saw Chinese shares fell despite positive developments in US-China trade tensions. So the China's CSI 300 index was actually flat through October, following a meeting between President Trump and Xi Jinping. China agreed to continue rare earth mineral exports and increase soybean purchases in exchange for a 10% reduction in US tariffs. Moving to the economic update now. So starting with Australia's economy. Australia's economic data was broadly disappointing in October. We had Australia's annual inflation climb to 3.2% in the 12 months to September compared to only 2.1% in June. And importantly, the important inflation data point, which is the trimmed mean inflation or core inflation, that was slower than the market and the Reserve Bank had expected. So that increased 1% in the quarter. And in the 12 months to September, it increased 3%. So that higher than expected inflation data has seen expectations for another interest rate cut in December diminish. And any prospect of a rate cut at the February 2026 meeting will crucially depend on the degree of any further labour market softening in the coming months and weakness in the November or the December Consumer Price Index monthly reports. Also in Australia, we had employment numbers rebound modestly in September. So we had 15,000 jobs created, slightly below the market expectation of 20,000, after we had a decline of 12,000 in August. The most notable development was a surprise increase in the unemployment rate from 4.3% to 4.5%. The rise reflects a labour market where a still strong supply of workers is outpacing weaker demand for jobs, resulting in more people being unemployed. Moving to the global economy now, in economic news out of the United States has been rather limited due to the government shutdown that's taking place over there. We had a special report on inflation that showed inflation in the United States rose 3% in the 12 months to September. We also had in the United States, in response to concerns about potential risks to employment, the US Federal Reserve, the US Central Bank, cut interest rates by 0.25%. Meanwhile, US-China trade talks produced a tentative agreement, so China will delay restrictions on rare earth exports, resume purchasing US soybeans, and crack down on the trade of fentanyl-related chemicals. So in return, the US will reduce its effective tariff rate on Chinese imports from 57% to 47%. Elsewhere, we had both the European Central Bank and the Bank of Japan keep interest rates unchanged, as widely expected. The Bank of Canada followed the Federal Reserve's lead and reduced interest rates by 0.25%. In New Zealand, we had annual inflation rise slightly to 3% in the third quarter, up from 2.7%. Again, that was in line with the market's expectations, so that the increase in inflation is only seen as temporary and is not expected to prevent further interest rate cuts by the Reserve Bank of New Zealand, which is looking to support economic growth in New Zealand. Thank you for tuning in to this month's recording or audio recording of the Runway Report. Thanks for tuning in to today's episode. If you want to learn more about Runway Wealth Management and how we help Australian expats, feel free to jump onto our website, runwaywealth.com, and we're also on all the social media platforms.